what we're going to be talking about here on this webinar is the DLP Income and Growth Fund. This is the first webinar we've ever done on the DLP Income and Growth Fund. This is probably the first time we've ever presented this fund in and of itself. So we've done a few webinars that a bunch of you have been on over the last month or two on the DLP Equity Fund 2. But this is the first time we've done one on the Income and Growth Fund. Had a bunch of requests to do so. And that's what led me to doing here this evening. So hopefully those of you who are already somewhat familiar with the fund, this will help bring more clarity to what we do, how the fund works. And for those of you hearing about it for the first time, hopefully it piques your interest and gets you excited, which I'm confident this fund will do. So I'm going to get started here with talking about the 2 keys to investing. And if you happen to miss anything here, I am recording this as well. So you'll be able to, we'll send out the recording of this just as a quick FYI. So 2 keys to investing. First is the manager, second is the strategy, is the way I like to look at it. Make things a little bit simpler. You got the manager and the strategy. Those are the 2 factors of whether an investment's going to be effective. So when it comes to the manager, which I'll start with, I am the CEO and the principal of DLP Capital Advisors. I have 2 partners as well that you're going to hear about in a minute. I've been in real estate now for a little over 11 years. I've closed now over 5,500 real estate transactions, nearly $700 million in closings, nearly 900 purchases as a principal investor. Ranked as the Wall Street Journal as one of the top 8 real estate professionals in the U.S. I actually just did an interview for the Wall Street Journal earlier today. They wouldn't tell me my updated ranking, but they did tell me it's higher. Then the new ranking comes out in a week. So hopefully we're now number 5 or 4 or 5 in the country is what my goal is. We've been number 1 in Pennsylvania for about 4 years. And I'm also the CEO of the rest of the DLP company. So here, the company that manages their investment funds that you're hearing about tonight is DLP Capital Advisors. We also have a direct lending partner, which is our lending company you'll hear about. DLP Realty, DLP Builders, and DLP Property Management are 5 of our core companies. We own over 400 properties, single-family homes, apartment complexes, and residential subdivisions. Today, we purchased a 128-unit apartment community in Brunswick, Georgia. You're going to see a little bit more about in a second. So in addition to myself, and I should mention because it is important, on the screen here are my 2 sons on the left with the Easter Bunny. They are 4 and 5. They are actually in the pool right now. I'm doing this webinar at my house, and my wife, Carla, there in the bottom of the screen. We're coming up on 7 years of marriage. All right, so the rest of my leadership team. So you're going to see a couple new faces here for those of you who've seen these presentations before. So the 2 partners in DLP Capital Advisors, and let me backtrack. This is the leadership team for Dream, Live, Prosper, which is the parent company for all the DLP family of companies. So these are the leadership team members across all companies. In DLP Capital Advisors, I have 2 partners, which are Bob Peterson, our CFO, who ran a $4 billion real estate company before coming to DLP a couple of years ago. Barry DeGroat, who's our general counsel, and again, a partner in the firm. Noreen is our new COO. She previously ran a couple large REITs, as well as a multifamily wealth management office. A lot of real estate background, as well as significant experience in COO roles, as well as organizational consulting. She joined us about 3 weeks ago. Was off to a great start, big addition to our team, and excited for many of you to meet her at our upcoming events. Jason runs our property management company, and we just brought on a quote-unquote number 2 for Jason, which is Jim Shearer. Jim's now our VP of multifamily. He's been head of a couple large property management companies, including Equity Residential Real Estate, one of Sam Zell's companies. Anybody's familiar with him, one of the largest real estate owners in the country. A couple other large firms. One of his last firms, he was overseeing 18,000 apartments. Wealth of background and knowledge. Lives in Jacksonville. actually about 20 minutes north of our office here in St. Augustine, and has been with us now for about a month. Larry Greenberg's our VP of Construction. Brian Nernell, Business Development, also runs our media company. Kevin, Head of Investing, one of our big deal makers. Larry, VP of Marketing, and Jonathan's our Sales Manager in Realty. And then Cindy is our Director of HR. So in Dlp Capital Advisors, most of the same people here that I just talked about, but also you'll see a couple of people that are very important for any of you invested with us or thinking about investing with us. Larry Hickernell is our Investor Success Manager. Many of you have spoken with Larry, helps really manage successful relationships with our investors, make sure we're giving you great service. Jeff is our Director of Accounting, comes from a background in tax accounting, handles a lot of our in-house tax work. Pat is our Financial Analyst, and analyzes all of our investments, both our loans and our acquisitions. And then Samantha is maybe the most important person, as she makes sure you guys all get paid. She's responsible for getting all the reporting and distributions out to our investors. She's our lead fund admin. And then Mandy's our investment coordinator, helps make everything run smooth. If you give us a call, she'll be the one typically who will pick up. She coordinates all of our events and is a great coordinator for us. This gives you an idea of all the different brands that under the Dlp Dream Live Prosper umbrella. I've already talked about most of those. These are all the core companies. Again, I've already touched on these, but it gives you a little bit more detail of how these companies work together. So Dlp Capital Advisors is the capital management firm, direct lending partners, how we make our loans. Dlp Acquisitions, actually a new brand that we're building for our acquisition business of branding ourselves when we're going out there and finding distressed opportunities, mainly multifamily properties. Dlp Builders, construction, realty, real estate brokerage, and property management, self-explanatory. So to give you a quick background on how we got started, how we got to the Dlp Income and Growth Fund to where we are today, and then I'm going to dive deep into this fund. So I started as a real estate agent 11 years ago. About 10 years ago, I started investing in real estate as a home flipper. Investors like yourself started lending money to us. We were paying out 8 to 10% fixed returns, and investors would lend us money. We would use that money to purchase and renovate houses. By bringing in investors and having them lend money to me, that allowed me to quickly go from 5 to 10 homes a year up to about 30 to 50 homes per year. We flipped a few hundred houses by 2010, which was around the bottom of the real estate market. And when we hit that bottom of the real estate market, we said, all right, now it's time to start building a rental portfolio, to truly start investing in real estate when prices are now at the bottom. We launched our first investment fund, which was called the Dlp Equity Fund 1, to go out there and acquire mainly distressed single-family homes, improve them. We flipped some houses, but most of the properties we've been improving and maximizing those properties, generating rental income, and we'll be selling those properties off over the next 2 years. We launched our second fund, the Dlp Fixed Fund, as a way to provide investors with fixed returns on their money. And consistent monthly distributions. And as we started bringing more capital into those funds, we started growing. We got to the point where we were buying over 150 properties a year. We had a lot of relationships, knowledge, resources. Our companies had grown. We realized that we needed to scale in order to continue to handle bringing in more capital, to be able to continue to do so effectively. And we decided to focus on 2 areas of growth. One was becoming a private lender. So going from being the person or the company buying distressed homes and renovating them to being the company that lends money to other investors buying and renovating distressed homes. So that was a significant transition for us in growth. We still to this day do buy single family homes, but we focus on being a lender on single family. And then we also realized that buying single-family homes scattered all across the Lehigh Valley, the Poconos, New Jersey, we would have 40, 50 homes under construction at all time, 240 carpenters and contractors working on our properties every day. We needed to scale as an operator as well and leverage this property management company, construction company, et cetera. And we decided to do that through multifamily and started focusing on purchasing 50-plus unit apartment complexes primarily. So sort of recap the beginning of our business to 2014, we purchased over 800 properties, flipped over 500, grew to the #1 real estate team in Pennsylvania, grew into a large construction company, had 3 funds launched at this point, and really took the path of focusing as being a lender and a multifamily operator over the past few years. So from 14 to 16, we grew our property management company by over 1,000%. We grew our multifamily properties we own by over 1,000%. We grew DLP Builders dramatically, and currently are building 2 subdivisions right now in addition to all of our renovation work. We grew to the #8 real estate team in the US, and we went from about 60 employees in 2014 to currently now about 175, and in 2016 about 150. And then a direct lending partner grew into one of the largest private lenders in Pennsylvania, New Jersey, and Florida. So we fast forward here to today to get to the income and growth fund discussion. We've paid out all of our investors 100% of the fixed returns and preferred returns, which are not fixed or guaranteed returns, every single month in every single one of our funds since they've been open. So we've never missed a target. We've never had any principal losses to any investors on any investment in any of our funds or outside of our funds. We currently have 5 active investment funds, including the DLP Income and Growth Fund. We now have about 240 investors invested with DLP Capital. We have about $220 million worth of assets, again, over 400 properties and over 200 loans. There's many of those in the DLP Income and Growth Fund that you're going to hear about. As of today, about 175 employees. This sheet is about a month old. We hired actually over 20 people in the month of May alone. We've been one of the 5,000 fastest growing companies in America for 5 straight years, going on 6. We did $50 million in revenue in 2016. And again, fast forward to today, as far as what we're focused on is we're buying multifamily properties mainly throughout the Northeast and Southeast, mainly even heavily focused in the Southeast, Georgia, North Carolina, South Carolina, and Florida. We're focused on 100 to 300 unit communities, although we have bought a number of 60 unit, 56 unit, 66 unit type communities as well, usually in markets where we can gain scale. And then we're focused on lending capital to real estate investors throughout the East Coast. And what the Income and Growth Fund does is it makes loans in both of these strategies. So it makes loans to DLP for the purchase of multifamily properties predominantly, not exclusively, but predominantly, and then to real estate investors primarily on single family homes, not exclusively, but predominantly, which you'll hear more about. Our path forward from here is to grow to over $1 billion in real estate owned, which will be about 15,000 apartments, and over $1 billion in loans under management, so $2 billion in assets by 2025. In reality, our real goal is actually to get there at this point by 2022. We've kind of sped up that pace. And by 2030, $1 billion of investor capital in our funds. So that's why we're doing these webinars. That's why we're out raising capitals. We're still heavily growing. We have 2 models that are really working effectively for us. We're generating great returns and looking to continue to grow. We're driven by 8 core values: positive enthusiasm, drive for greatness, grit, delivering wow, solution focused, accountability, and some reason 2 of them got deleted there. But those are our core values, our primary ones that drive us to what we do and how we behave in terms of how we treat our employees, our investors, our tenants, everybody we come in contact with. So as I go through these returns in a second, it's very common to think, wow, this looks too good to be true. How can you really generate these kind of returns? There must be a high level of risk here. How can this be true? So this presentation is really for anybody hearing about us for the first time, to help convince you that this really is a great deal. It's not too good to be true. We're doing this right here, right now. We have many of our happy investors on this call right now, many of who I know would be happy to talk to anybody who's not currently invested with us and tell you their actual experience with us. So speaking a little bit of people's experience and a little bit of credibility behind what we do, we're approved through 94% of brokerage custodial platforms, including Charles Schwab, Fidelity, TD, and many others as well. 94% of the platforms, independent brokerage custodial platforms in the country. We also have third-party financial audits. The Income and Growth Fund 2016 audits are just being finished up right now. There are a few income and growth fund investors on this webinar here, so I request from you guys to please send back your confirmation forms to our auditors. That's the last thing we're waiting, is they mail out confirmation forms verifying some of the financials of investors' accounts. Investors have to sign those and send them back, just verifying that our books are accurate. So that's the last item to be finished up, and those audits will be up on our portal and sent out to all of our investors. So those should be out by next week. We're an approved investment option for RIA, or registered investment advisory firms, as well as a couple family offices as well. So we're working with institutional quality investment managers and family offices now, which again, they put us through heavy due diligence and have a lot of experience doing that. And we've passed everybody's quote unquote test with flying colors to the quality of our funds, our transparency, as well as, of course, the returns. You can invest in all of our investment funds with your IRA or with any qualified funds. The Income and Growth Fund is probably arguably the best fund that we have in terms of utilizing qualified money, because when you can earn double-digit returns with liquidity and avoid tax, I don't think there's a better formula out there. Or you can keep your money in bonds and mutual funds and listen to that financial advisor there and think about aging slower, as many people's IRAs and have not been improving or growing at the level that, of course, we need or would like to achieve our financial goals. We're endorsed by big personalities, guys like Sean Hannity, Bobby Gunther Walsh in Lehigh Valley, Rich Jones in Jacksonville, St. Augustine area, Glenn Beck. So let's get into the fund, what we do, where we do it. As I mentioned before, historically, we've been in Pennsylvania, New Jersey, Florida. We've been expanding into other markets here. Our concentration of activities are in Lehigh Valley, Poconos, Jacksonville, St. Augustine, Daytona Beach, Orlando, and then we're lending throughout the East Coast. Here's it on a map. This is about a month old, so it's missing a few properties, but we have a lot of properties in Pennsylvania, as you can see in the upper left, 323 properties, 47 loans. We're starting to fill out the middle of the East Coast there, the Carolinas, Georgia. You can see the little markers on a map as well. And again, that's expanding. On the middle is properties we own. On the right are our loans. The loans especially are filling out up and down the East Coast. Based on the amount of capital, 51% of our assets are in Pennsylvania, 26% in Florida, 9% in Georgia, 8% in New Jersey, 3% in each of the Carolinas, and about 45% of all of our capital is in single family. They're single family homes we own or have loans against, 40% in multifamily, 15% in commercial. All right, so let's get into the fund. One of my great sayings, I know many of you have been with us for a while, I've heard this many times, but Warren Buffett, how he became so wealthy, living in America for great opportunities, having genes to live a long time, and compounding interest. This fund is all about consistent returns, compound effect of generating double-digit returns consistently, month in and month out. Often investing can seem confusing, like this picture here, not sure which way to go. I believe, especially after watching a webinar like this fund is very simple in how it generates its returns, and it makes finding an investment vehicle that can kind of check all the boxes of what you're looking for in an investment very clear and straightforward. So what does the fund do? We make private loans to real estate investors. The opportunity is in the marketplace to lend like we do for a number of reasons. Number one, banking regulation issues. One of the most common topics throughout the election was the need to remove regulations, the need to repeal, Dodd-Frank and these different restrictive programs. Banks are under a ton of regulation and compliance issues that makes it very difficult for them to lend on real estate at all, but especially to lend on distressed assets that don't have income coming in, like most of these properties are not occupied. Investors need reliable capital and the ability to close quickly. We're in a country with aging housing, very little new construction going on as a national whole. There's certain markets that are exceptions to that, like where I'm located right now, St. Augustine, which is the fastest growing county in America in terms of new construction. But as a whole, there's very little new construction going on. Housing stock is getting older, meaning it's aging. It's in need of repair. So there's a constant need for homes to be renovated. Even in markets like today, when there's not a lot of foreclosures, there's still a huge need for homes to be renovated and improved, and that really isn't going to change anytime, despite the market cycles. And then investors are looking for short-term loans. They're buying, renovating, and selling, or buying, renovating, and renting, and then refinancing into longer-term financing. So we're doing short-term lending that banks really can't do either. So we solve the gap in capital for real estate investors by providing short-term, first-position loans. We're able to not only provide investors with capital, but come in and help improve neighborhoods by improving the ugly duckling in the neighborhood. We drive local economies by employing the construction industry, provide jobs. We provide turnkey housing to families, whether they're people looking to buy a home, a lot of first-time home buyers for these types of homes, or for renters as well. Why should you be interested in this fund? First of all is liquidity. So most real estate related funds are illiquid. This fund, you can redeem your investment with just 90 days notice. That's what the fund documents say. The reality is we can honor redemptions much faster than that. Actually, one of our investors just an hour or two ago talked to Larry and said he needed to redeem out, I think it was $40,000 or $50,000 out of his investment by Friday, because he's got something to take care of for tax, and we'll honor that and he'll have his money by Friday. 2 days notice, 3 days notice. We've done those things many times. Our investing is liquid in nature. 40% of all of our loans pay off every 90 days. So we're highly liquid, which allows us to create liquidity for our investors. But our documents say 90 days. We can do even faster than that. But even so, 90 days is highly liquid for these types of funds. The returns are very consistent, as you'll see in a moment. The returns are double digit for our equity returns. We do have the option of investing as a fixed return investor, as a note holder, which we'll talk about, but for our equity investors, it's double digit returns. Again, we're making short-term loans. So a lot of people say, well, what happens when the real estate market goes down in 2 years or 3 years or next year? We're not tied in 5-year loans, 10-year loans, where we're going to be stuck with these assets as property values are declining. Our loans are 6 to 12 months, typically only 6 months. We have very strong risk mitigation by lending to quality borrowers, requiring a lot of cash invested, having low loan to values, and again, the short duration of the loans. Our average loan to value is just 54%. Our average loan to cost is just 73%, which means a lot of cash invested. Some of you have heard me say this a few times, but out of the 10 million homes that foreclosed in the downturn of the real estate market, less than 10,000, less than 0.1% of the foreclosures, the borrower put 20% down. In the single thousands, borrowers put 20% down. And those are homeowners, people whose all their income is typically tied to a singular job. Our investors are real estate. Our borrowers are typically real estate investors who are experienced. Our average net worth is over $1 million. Our average liquidity is 6 figures. Our average credit score is over 700. So we're lending to good quality, experienced investors with on average 27% of their own money in the property at an average loan to value of just 54%. Because of that, we've had 0 foreclosures. We've had very little defaults. We've lost no money on any loans that we've made to date. Over the course of this fund, we expect half of the capital to be lent out to real estate investors not affiliated with Dlp Capital, and 50% of the capital to be lent out to Dlp affiliated entities, meaning properties that effectively, in short terms, properties that I'm the owner or a owner in. Loans to properties that we own, where I'm the borrower, a company we own or the borrower, are currently primarily against multifamily properties, and loans to non-Dlp entities are currently primarily single-family properties. We're not lending to this guy. So the money is either going to us as the owner of the property or to experienced investors. Now, as you see in the description, first time flipping houses. We're not lending to the guys hoping to be home flippers. The vast majority of our investors are professionals who've already flipped 10 plus houses before coming to us. This gives you a couple quick snapshots on some of our sample loans: Allentown, Pennsylvania, Newark, Downingtown, Sarasota, Bluebell, I should say there. the loan to values that we lend out on these properties, the interest rates we charged. Our current portfolio average interest rate is 13.1%. Here's a couple case studies of loans. So on your right, you'll see the before and after pictures of this property. This is a loan that we just did, just paid off. So they came in, put a new kitchen in, stainless steel appliances, new bathrooms, all new flooring, new mechanicals, new lighting. So we did a loan for $68,000. It had an after repair value, the completed value of $140,000. Our loan to value was under 50%. Our loan to cost was 76%. Borrower had a 728 credit score, had done more than 10 flips, had a net worth of $500,000. We were at 13.2% interest rate. And he sold it exactly for the appraised value, coincidentally, on that one. Here's another one. Again, you see a little bit of before and after on that. Bathroom remodel, kitchen remodel. So loan was only $95,000 on this one. The value at completion was $175,000. Our loan to value was only 54%. Our loan to cost on this one was 81%, meaning he put 19% out of his pocket. This is an investor who's done a lot of loans with us, so we gave him a little bit higher loan to cost than we would for a first-time investor. He has a 714 credit score. He had done 7 flips with us as the lender in 2016 alone. He had a net worth of $1.6 million. Again, interest rate of 13.2%. Investor successfully sold the property and sold it within 5 months, and he made about $40,000. We earned a 13% interest rate on that loan. Here's a few more of our loans. Bethlehem, Newfield, New Jersey, Newfound Harbor. Again, showing you kind of some of our interest rates, loan to values, typical single family homes and secondary markets, suburbia, USA. Very little of our lending is in any big cities. It's typically single family homes and secondary markets like a Lehigh Valley or St. Augustine, Florida. So that's our lending side, the type of properties we're making loans on. On our acquisition side, the type of properties we buy. Anybody who's familiar in the DLP Equity Fund 2, you'll be familiar with these types of properties that we're buying, but B and C class multifamily properties. A very strong market for a lot of reasons. Home ownership is declining. Family formation is happening later. People want more flexibility. There's a big demand for affordable housing. So this is a property we literally just bought today in Merritt Landing, as what's called in Brunswick, Georgia. So this is an example of why we did this loan with the DLP Income and Growth Fund. We won this auction 21 days ago. And when we won this auction, we had to wire $525,000, which came out of one of my companies that I own. We had to wire that money same day with no contingencies. So, I take all that risk myself. We had to close then within 21 days with no contingencies. The purchase price was about $5.5 million. The total costs at closing today were $5.8 million. We did take out a loan from a private lender we work with out of California for $3.9 million. DLP Income and Growth Fund will do a second position loan on this property. We don't have a lot of these, but we do have some. But to give you an example of when we would do it, would be a situation like this. So it did a second position loan for $500,000. And then I invested $1.4 million of equity on top of that $500,000 income and growth loan. So a lot of equity invested on top of it. And this property will be worth within a year over $9 million. 128 units, 40 of these units were in need of renovation. They were down, hadn't been occupied in years. Rents were low. This has been owned by a bank for about 8 years. There's some sample pictures, a site of the community, has a laundry room, pretty decent condition of properties, nothing fancy, but they're in pretty good shape, the ones that are not down. There's a leasing office. So the strategy on this property is to get all the 40 units renovated, increase the rents, improve the occupancy, and then refinance this property, pay off the income and growth fund with agency financing. And the value will be about $9.5 million within a year from today. So it's an example of a type of property that the Income and Growth Fund could make a loan on that we own. This is another example of a community we own that's been doing very well. Actually, some of the people in this call are actually investors in this property. Income Growth Fund does not have a loan on this property, but this is an example of types of properties we buy and what we do to these properties. We often are coming into these apartment communities, demoing units, putting in bathrooms, doors, flooring, paint, similar to the single family renovations. These are some examples of one of those units when we bought the property. And here's what it looks like after we finished renovating the unit. So we're improving the quality of the property, which as an investor in the fund is a good thing. That means capital is being invested and you're in the equity position. The property is improving, mitigating risk to the fund. So let's talk about the actual performance of the Income and Growth Fund. So the Income and Growth Fund has been open since January of 2016, so 17 months now. The goal is to generate an 11% plus annual net return to investors. We will have our audited financials done by next week for 2016, our first year. The net return to the fund in Q1 of this year was 12.28%. We've been between 12.2% and 13.02% every single quarter. The average to date is 12.63%. In Q1, about $2.5 million of new capital came in. This fund, as of today, has about $11 million in this fund. And again, it's about 17 months old. If I had to project forward for the next 12 to 18 months, I project the returns will actually be a little bit higher than this. I actually think the returns are going to be closer to about 14%. As the fund has gained size, it actually helps us to be able to manage the flow of capital better, deploy the capital better. We actually expect those returns to tweak up over the upcoming quarters, as again being in at least the 13s, but likely could hit 14 net returns to investors. So this is the net to you after we earn our management fee and our percentage of the profits, which I'm going to talk more about. Another really important thing I want to touch on here is, as I was showing you some of those loans that we make in this fund, one of the very unique things that I've never talked about, at least I don't believe I've ever talked about before in how the Income and Growth Fund operates, is if a loan were to go into default, if we were to have a loss on a loan, the general partner of the fund, which is us, Dlp Capital Advisors, has a 2.5% interest reserve account that's funded to cover any losses on a loan. That reserve account is actually being funded or is funded by Dlp Capital Advisors. We've funded a reserve account to cover any losses out of our profits, not out of our investors' capital. So it would actually be our money that would be lost if we ever did have a loss on a loan, not the investor's money. Which is pretty unique in structure, and that we're taking, being a stop, drawing a blank on the term I'm looking for, but we're able to come in and mitigate. Hey, we do have a loss. We're going to cover that loss, and I think right now that accounts about $60,000, which is 2.5%. That would come out of our pocket, and not in any way, shape, or form touch the investor's capital or your returns either. So I know what you're thinking. Wow. So with that said, I'm going to cover a couple more things, and then I'm going to open it up here to questions. So right now, out of all of the lending we do, this gives you a breakdown of where it's located. So 37% right now is in Pennsylvania, 23% in Florida, a little bit in Georgia, a little bit in the Mid-Atlantic region, a good amount right now in New Jersey. I don't expect it to remain that high of a percentage, but right now it's about a third. Right now, 74% on single family, 22% of multifamily, and 4% on commercial. So here's the overview of the fund in a graphical format here, chart format, I should say. So first, I'm going to show you investing as a partner in the fund. I'm going to show you if you wanted to be even more conservative and you wanted to just lend money and get a fixed return, how that works. If you want to be a limited partner in this fund, the preferred return is 10%. That's how much you earn as an investor before we earn anything. So again, it's a 10% preferred return. The target return is at least 11% net to investors. So the 10% preferred return plus 80% of all profits in addition to that 10%. So you get the first 10, you get 80% of all the profits. We earn a 1% management fee, but that 11% plus return is net of that management fee. We do have audited financials in that the audit's done. We're just waiting on those confirmations to come back, and we'll be producing and sending out the audit by next week. You can invest through your IRA. You can invest through your brokerage account. It's a 1-year investment, but you can redeem your investment with just 90 days notice, even within that first year. Our assets are mortgages, notes, and personal guarantees. That's the collateral of our investments. They're loans. The income we're earning is interest income. All the income we're earning, the day we invest money through this fund, we're earning a fixed return back on that money the day the money goes out. If you wanted to invest as a note holder, which means you're actually lending money to the fund instead of investing as a partner in the fund, you can do so and earn a fixed return on your investment from a 6.5% fixed return up to a 10% fixed return. You can choose to take those distribution monthly, which is what the returns on the left are, or you can let the returns compound and grow, which is on the right, reflecting a compounding return. Also, if you're a limited partner here, you have the same option. You can have these distributions paid out to you, or you can have it reinvest. Your choice. You can switch at any time. And how the investments pay out as a limited partner, or as the returns pay out, is a 10% preferred return gets paid out monthly. So you get that return on a monthly basis. And then all the profits over 10%. So historically, our returns have been 12.8%. So that 2.8%, the amount over the preferred return, that gets paid out quarterly after we go in and calculate what were the total returns for the quarter. We give 80% of those returns to the investor. We keep 20% and pay those returns out in a sort of fourth distribution of the quarter. So you get 4 distributions each quarter. The preferred annualized 10% return each month, and then all the profits over 10% paid out on a quarterly basis. Again, as a note holder, you get paid every month, or you can choose to have it compound and grow. You can always do a combination in either of these options. You can say, I want X amount paid to me each month. I want the rest to compound. You do it kind of however you like. It's 100% at your discretion. So why would you want to be a note holder? You get a fixed return. It's the lowest risk of any of our investments. You're the first to get paid. In the terms of risk, equity investors would have to lose every dollar they invest before a note holder could lose any money. Again, from the equity standpoint, we've had 0 losses in any of our funds to any of our investors, and we've never even missed our 10% preferred return in any of our funds. One of the great things about the Income and Growth Fund in comparison to our lending fund or in comparison to the equity fund too is diversification. So you get great diversification between some of your capital is being invested basically with DLP as the operator. Some of it's being lent to investors unrelated to DLP. You get diversification of single family, multifamily, a little bit of commercial. You get a lot of geographic diversity. It gives you a wide range of diversification really across each sort of checkbox in the terms of investing in real estate, which of course our diversification is a great way to mitigate risk. With that said, I know it's a lot of information, a little bit easier just hearing about this fund than all the funds at once. So hopefully it didn't feel as much as that picture shows of a fire hydrant to the face. But with that said, I'm going to go ahead and open it up to questions. Again, you can type those questions into the chat box, which you should see sort of the bottom of your screen there. And happy to dive into any and all questions. While people start typing questions in, I want to just mention to everybody about upcoming events. You can always go to dlpcapitalevent.com and see all of our upcoming events. Our next events are going to be Thursday, July 20th, will be an informational dinner in Danielsville, Pennsylvania at the Woodstone Country Club, but it's not listed there for some reason. But we're also doing our quarterly investor get together. So we're going to do a happy hour before the dinner, which is open to prospective investors. And we're going to do about an hour-long happy hour where it's only for DLP investors. The last one of these we did at Hotel Bethlehem. We had an amazing turnout. I think it was about 70 of our active investors were there. We'll give you a sort of a verbal commentary update to everything that we give you on your quarterly reports and that we're communicating to you throughout all of our communication. And it's a great way to meet so many other amazing investors. We have actually a number of our investors who live in different parts of the country. Some live in Florida, one who lives in North Carolina, are actually coming up to that dinner to get to meet a lot of our other investors and get to be there live. But we also stream these dinners via the web as well, so you can also watch them, and we record them as well. And then our next dinner in Florida will be at some point in early August. We're still finalizing that date in St. Augustine, Florida. So those are our next two events. So with that said, I'll go back to the overview slide here on the returns and open it up to questions that anybody may have.
Hey, Don, this is John.
Hey, John.
Hey, I got a question about this fund. So I'm just trying to understand the diversification aspect of it. Is it correct to view the income and growth fund as somewhat of a hybrid of the other funds in terms of diversification? It seems to combine some of the elements of all the other ones into one.
Yes, yeah, absolutely, absolutely, it is. So some of our previous funds, the Dlp Fixed Fund, which as you're familiar with, is a fund that lends basically only to DLP as the borrower. The lending fund pretty much just lends to non-DLP investors. This fund does both. So it is a combination. It really lends across everything that DLP does, which helps us to make sure we're maximizing our ability to deploy capital, which is the #1 factor in us generating our returns, but also provides diversification, as we discussed. So yes, it's in many ways it's sort of a hybrid of and an evolution of the rest of our funds.
Yeah, good. Thank you.
Also, a question here. So one of the common questions that people ask when they first hear about this is or think is, how do we go about determining, like, if it's a loan made to a non-DLP investor? So as I mentioned a moment ago, the lending fund only makes loans to non-DLP investors. It can make loans to us, but it doesn't currently, and it hasn't in a while. But it could, but it currently is not. So how do we go about choosing, if the loan goes to the lending fund or if the loan goes to the income and growth fund? And we've avoided any conflict there, and really made sure that neither fund is in a position of taking any additional risk. And by making the investments to non-DLP investors, the loans, in one of two ways. Either one, the income and growth fund actually invests into the lending fund as a limited partner, just like you would. So it actually owns units in the lending fund, and that allows it to have a complete diversification of the lending fund loans. Or it can invest as a participation, an equal participation with the lending fund on loans. Lending fund could own 50% of the loan, income and growth fund own 50% of the loan. Both have the same risk profile. So we make sure we don't put ourselves in a position where we're having to choose which fund we make the loan out of. All right. Any other questions we have here? A quiet bunch here tonight. A lot of people on here yet, waiting to hear other people's questions. But anybody else have questions? Feel free again to type them in here, or if you want to go ahead and chat like John did, you can gladly do so as well. Some of you are on mute, but that's I believe for you guys, you can unmute yourself. We don't have anybody on mute, so you can click the little mic button and take yourself off mute if you have a mic and wanted to go ahead and verbally ask your question as well. You're more than welcome to do so.
Hey, Don, I have a second question, if I may.
Sure, John.
How does a REIT work, and how does it compare or contrast to the DLP diversified approach?
Great question. So a REIT is really just a designation of a fund and sort of a filing of how you file the fund. But I'm not prepared to go into complete detail yet on, because we're still finalizing. But very likely, we're actually going to be going through a process of converting the income and growth fund and the lending fund into a new type of REIT, which is called a Reg A plus REIT. which the benefits of that, there's no change to the returns, no change to the structure, no change to anything other than really how it allows us to manage the fund. So the things that will allow us to do is, number one is it'll remove a restriction that these funds, the way they're structured now, is we can only have 100 investors in the fund. So by making that election into a Reg A REIT, we do not have to abide by 100 investor minimum or maximum. We can have unlimited number of investors, or virtually unlimited. The next thing it does for us is it actually allows us to take in unaccredited investors into the fund in addition to accredited investors. Right now, these funds are only available to accredited investors. And what was the third? And the third thing is it takes away some of the requirements of us to do certain filings. Like right now for our funds, we have to file what's called a blue sky filing in every single state that an investor who's in the fund resides in. We have to do a certain filing. It removes that requirement, which is we continue to bring in more investors in more states, and saves us some time and money. So actually, Bob and Barry, our CFO and general counsel, just had a call with our securities attorney about 2 hours ago, and we're kind of finalizing that structure of that conversion. Again, doesn't change the returns or anything else that we do, any of the reporting. It's just an election that gives us more flexibility of growth.
Yeah, sounds good.
All right, so we got a relatively quiet bunch here tonight. So a couple comments for many of you who are current investors, about half of you on this call today. You'll see that it says a $250,000 minimum investment. Those minimum investment amounts are your total account balance with DLP. So that means if you're an existing investor, you can invest any amount of money into the income and growth fund. So if you could say, hey, I got 25 grand free, 50 grand free, 100 grand free, that's fine. If you're a new investor, that $250,000 minimum could be spread amongst our funds. So if you're looking at this fund, you say, hey, I also really like the equity fund too. You can split that investment amongst multiple funds. And then our note holder option here has a minimum of only $100,000. Then you could do like one of our investors who's on the call here today who just invested with us. He came in and he said, all right, I'm going to do 200 grand into the equity fund as a limited partner. He did 200 grand as a note holder. And then he did 200 grand into the equity fund too. And he broke it amongst two different funds, 3 different options. And that's how he chose to diversify. Many of our investors are in multiple funds. Many investors split between being a note holder and an equity investor. It's all depends on your goals. And that's one of the things we like to do is, if this piques your interest, we'll send out, see if anybody doesn't already have it. We'll send you a link to our portal on our website where you can log in, see past dinner presentations, webinars on some of our other funds, see our financial audits, see our quarterly reports. We give out on all of our funds. Like when you look at the income and growth last quarter report, we show you the actual P&L, the actual balance sheet, a full commentary report on the fund, and an actual list of assets. So there's no black box. You get to see everything that's going on. You can log in and look at all that information, and you can kind of, then what we like to do is, once you kind of take a look and this sounds like something that is of interest to you, what we like to do is sit down with you one-on-one or have a call. We discuss what your goals are, what you're trying to accomplish, and help work with you to lay out, the best plan based on your situation and your goals. And it's one of the things that I absolutely love to do, as does Larry. And we work to make these funds work for your financial picture and what you're trying to accomplish. So with that said, I'll do one more call here for any additional questions. And if not, we'll end this recording. And again, this will get uploaded and sent out as well.
Can I ask one last question, Don? I don't want to hog the phone.
People are staying on, so that must mean they're liking your questions here, John. So keep them coming.
I'm just looking for your perspective, like your overall outlook, because we could get a lot of details here. But like, what would you be off the top of your head, your 5-year kind of perspective for investor outlook for the next 5 years? Just your overall outlook on that in the real estate, opportunities that you have.
Yeah, great questions. Great question. So a couple things. I mean, as far as how the real estate market looks, looking out over the next 5 years, first comment I make is, anybody who tells you they can see out accurately more than the next, year to 2 years, is probably pulling your leg. So, with that said, we did project out back in 2007 when we started going to downturn, kind of when we'd hit the bottom, when we'd hit the next peak, and thus far we've been pretty much dead on. And the Equity Fund 1, our first fund, was really designed to time, and it's been working out perfectly. That we projected out that in Pennsylvania, New Jersey, that we would hit the next peak in the residential market, the home market, by about 2020. I believe that's still to be the case, that property values will continue to climb over the next 2 years to 3 years, and then we will hit that next peak. How dramatically it declines again, and exactly how things go as far as interest rates and other factors, who knows? But I do expect that we'll hit a peak, and there will be some sort of correction in 2 to 3 years in the Pennsylvania, New Jersey region. Typically, Florida and some of the other markets like in Arizona and Nevadas and California, they'll typically start correcting about a year sooner. So I think a lot of markets in Florida, markets like Miami, as an example, are already starting to correct right now and have already started to see a decline. But I think most of Florida, will peak out next year to 2019. So what that just means is there's going to, be some decline in home values. Again, how drastic that's going to be, how much foreclosure there'll be, I don't know for sure. I think there'll definitely be some significant corrections there. So for us as a lender against single family properties, it doesn't worry us, at all, as far as we pay very close attention to it. We try to communicate it effectively. And again, our loans are only 6 months. So, over the next 6 months, 12 months, when these loans that we're making today, the decisions we're making today will be paying off, we know the market's going to be, we're very confident the market's going to be very strong. As the market starts shifting and prices start going down, we may have to adjust our guidelines. We might have to lend to only the highest quality borrowers. We might have to lower our LTVs even more so. But a lot of the best investors make the most money in a down market, and there's the most distressed opportunity, which is what we're lending on and investing in. So from that standpoint, we think for us as an operator, there's going to be amazing opportunities as the market corrects. We want to be in the position in this next downturn in the next 2-3 years to do what we did in buying single family homes in the last downturn with larger multifamily assets. We think there's going to be a lot of opportunity to pick up these 100-unit, 200-unit apartment complexes from banks and distressed situations here at some great pricing in the next couple of years. But for us as an operator, we're also very confident that we're going to be in a really great position because the properties we own, the assets we own, are income producing assets that produce double-digit income right here, right now, not based upon rent growth, not based upon appreciation, based upon what's going on right here. We believe, as from a macro sense, the rental market, apartments, is going to be very strong for a long time to come, especially in the affordable housing markets that we own assets in. So we think, we'll continue to generate very strong cash flow, very strong returns through a downturn, and have a lot of opportunity for acquisitions.
Great. Thanks, Don.
Thanks, John. Everybody, that's John Myro, who's an investor in pretty much all of our funds and a number of deals with us, been with us for years, and he's always more than willing to chat with any prospective investors as well and give his perspective. He knows as good as anybody, as he pays very close attention and is very involved with what we're doing. So he's always willing to help. And he also has a great video of him and his better half on our portal as well that you can watch, John and Mary Ellen, where they kind of talk about their experience as well, which is a pretty awesome video.
Happy to do it.
Thanks, John. All right, so then I'll let everybody go. Thank you again, appreciate it, and we'll do another webinar, probably next one on the Equity Fund 2 in the next couple of weeks. We're going to try to continue to do these webinars and mix them up. So if you have any requests for whether it's on a specific fund or just specific question or insight or whatever the case you can think of, feel free to let us know. We're always happy to do so. A few of our investors asked for questions about our geographic expansion of our lending business. a couple weeks ago, and we did record a great video on that. That's actually going to go out to our database. All of you will get that tomorrow, explaining how going into all these new markets in our lending business is actually mitigating risk in a lot of ways. So hopefully you like that video. So anytime anybody has questions, information you'd like to know more about, just send me a message. Either we'll get you the information one-on-one, or it'll help lead us to answering the question for many others as well. So again, thank you everybody for sticking with us here through this whole presentation, and hope to see many of you soon. Thanks.